It is widely believed, with plenty of evidence to support the hypothesis, that tax cuts spur economic growth. Let's take a step back in history and visit the 1920s and the 1930s. In 1923, Calvin Coolidge took office and passed a series of reforms that would cut taxes mostly for the high earners. He abolished the highest earning tax group, bringing the rate of incomes over $200,000 down to 25% from 58%. What followed was a period of great prosperity in the United States. The Roaring Twenties was a decade of economic growth and widespread prosperity. But then came the Wall Street crash of 1929 and the Great Depression of the 1930s, the depression that lasted for almost a decade. Over the past 6 decades, tax cut legislation has been implemented by elected officials of both political parties. The Kennedy tax cuts of 1964, Reagan's tax cuts in 1981, the Clinton tax cuts in 1997, and the most recent Trump tax cuts in 2017. All did what their advocates said that tax cuts would do. They increased economic growth rates and, secondarily, enhanced government revenues. So what is the economic logic that leads us from cutting taxes to greater economic growth? If you listen to pundits and some economists, both conservative and liberal, you will frequently hear that it's all about increased spending. Because the tax cuts put more money in people's pockets, they spend more. And it is the increased spending that ultimately stimulates the economy. While this sounds plausible, it is essentially wrong. Increased spending on parts of consumers or taxpayers as opposed to the government is an effect of economic growth, not its cause. The fact is that the money from these tax cuts would get spent with or without the cut. If the taxpayers did not have it to spend, the government would. Spending is not what drives economic growth. Earning is. No one can spend income that they haven't first earned, either through work, entrepreneurial activity, or investment. And tax cuts of any form, particularly if they come in a form of rate reduction on income, enhance the incentive to earn, or more accurately, reduce the disincentive to earn. And how do people earn money that ultimately translates into spending? It is through the production of goods and services that other people want. In other words, increased production is what drives economic growth and increased consumer demand. And it is the drive and effort to increase one's earnings that ultimately increase production. Taxation is a disincentive to earning. The higher the marginal tax rate on any form of income, the less one is allowed to keep from any additional dollar earned. This means that it is less likely that the income earner would do what it takes, that is, work more, invest more, build more, hire more people to earn an extra dollar. The higher the tax, the lower the production and therefore earnings. It is much more likely that a person will pursue and earn an extra dollar if they can keep 80 cents of it, that is 20% marginal tax rate, compared to if they can only keep 40 cents, that is a 60% marginal tax rate. This is true for all kinds of income. A lower tax rate on regular income increases the incentive to work harder, acquire more skills, and log overtime hours. A lower tax rate on interest and capital gains income encourages people to invest in both existing and new entrepreneurial ventures. Reduced corporate income taxes also encourage investment by increasing returns to shareholders and leaving more earnings available for business expansion. One or more of these forms of tax reductions were part of all tax cut plans mentioned above. For example, the recent Trump tax cuts focused on corporate and individual rate cuts, while the capital gains tax was primarily the focus of Clinton cuts in the 1990s. In North Carolina, the successful changes passed in 2013 saw a dramatic tax reduction. Over time, the top income tax fell from 7.75% to a flat 5.25%. But because there is no distinction between regular income and investment income in North Carolina tax code, this meant that there was a dramatic tax cut for all incomes, regardless of how it was earned. What all this means is that the incentive to earn more income, that is, be more productive in North Carolina, has increased, not just internally, but relative to other states in the region and nationally. On average, every year since the passage of these cuts, North Carolina's economy has grown nearly twice the rate of national economy. This has occurred not because of how much consumers in the States have been spending as a result of tax cuts, but how much productive effort has been committed to the pursuit of earning. Now let's revisit the Roaring '20s we talked about at the beginning of the video. It is certainly true that there was general economic recovery in the 1920s. It could therefore be theoretically argued that tax cuts did have an impact. However, given that the tax cuts came while the US was coming out of a deep recession, it can be argued that we would have seen some sort of transition from slump to recovery, no matter what the course of action was. And other countries with very dissimilar tax regimes experienced very similar strong growth during this period, which makes it seem even less likely that it was the tax cuts in the US that boosted growth. The international experience suggests that even if there were no tax cuts in the 1920s, the United States would have enjoyed a buoyant decade economically.